Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome back to Aviation Intelligence Weekly. I'm Sarah Chen, and joining me as always is Mike Torres. Mike, today we're digging into GE Aerospace's Q2 2026 10Q, filed July 16th. This is a company that has genuinely become the spine of the global commercial and defense aviation ecosystem, and this quarter's numbers are striking. Let's get into it.
Thanks, Sarah. And you're right. This filing deserves serious attention. Before we get into the mechanics, let me give listeners our core thesis up front. If we reduce this filing to one sentence, it's this: GE Aerospace is executing a volume-led supercycle with accelerating backlog accumulation, but margin compression is quietly eroding the quality of that growth.
Unpack that for us.
The top line is exploding. Revenue up 21% year over year in Q2, 23% for the first half. Engine deliveries up 37%, LEAP deliveries up 41%. The backlog, what they call the remaining performance obligation, grew $20.2 billion in just 6 months. That's not a company in recovery mode. That's a company riding a structural demand wave.
So, where does that put them in the cycle?
Based on this filing, GE Aerospace is operating in mid-cycle expansion, but with late-cycle margin signals beginning to surface. The volume is there, the pricing is there, but the margin trajectory is moving in the wrong direction, and that tension is the central story of this quarter. We'll come back to test that thesis at the end.
Let's talk numbers. The headline figures quarter over quarter are dramatic. Walk us through what changed.
So the XBRL data shows revenue jumping from $12.39 billion in Q1 2026 to $25.74 billion in Q2 2026. That's a 107.7% sequential increase. Net income went from $1.90 billion to $4.27 billion, up 124.4% sequentially.
Those are enormous sequential moves. What's driving that?
We need to be careful here. The filing covers both quarterly and half-year comparisons, and management's own language focuses on year-over-year comparisons rather than sequential. What the MD&A explicitly states is that for the 3 months ended June 30th, 2026, total revenue increased $2.3 billion, or 21%, compared to the same period in 2025. The sequential jump likely reflects the cumulative 6-month revenue being reported, but we won't speculate beyond what management disclosed.
Fair point. So on a year-over-year basis, what's the causality chain management is describing?
Management is very specific. In the consolidated results section, they state, and I'm quoting directly, revenue increased, quote, driven by increased engine deliveries and improved pricing, and services revenue increased due to, quote, increased internal shop visit volume and work scopes, higher spare parts, volume, and pricing. So you have a dual engine of growth, new equipment out the door, and the aftermarket pulling hard simultaneously.
And that's unusual, right? Typically, those two move in opposite directions.
Exactly. In a normal aerospace cycle, when OEM deliveries surge, aftermarket tends to lag because new engines don't need shop visits immediately. The fact that both are accelerating simultaneously, internal shop visit revenue up 30% in the first half, engine deliveries up 37%, tells you the installed base is both growing and aging at the same time. That's a structural tailwind, not a cyclical blip.
Now, the causality chain on the downside. What breaks if this persists?
Here's the tension. If higher install engine deliveries continue to outpace services growth, and the filing explicitly notes that higher install engine deliveries partially offset profit gains, then margin compression becomes structural, not temporary. The filing shows Q2 profit margin at 21.0%, down 70 basis points year over year. For the first half, profit margin was 19.4%, down 270 basis points. To put that in context, aerospace engine manufacturers historically operate in the 18 tone gate of 24% operating margin range at mid-cycle. GE Aerospace is still within that band, but the direction of travel matters. If that 270 basis point compression persists into the back half. You're looking at a company where revenue growth is outrunning profit quality.
Let's talk about the tone coming out of the MD&A. What signals are you picking up from how management is framing this quarter?
The tone is confidently forward-leaning, but with deliberate hedging on two specific fronts. On the demand side, management is unambiguous. They state, quote, "Demand continues to be strong," and they back that up with a list of major new deals. United Airlines and Delta selecting GEnx engines for Boeing. Boeing 787 orders, American Airlines and Copa Airlines selecting LEAP engines, and Ryanair signing a long-term material services agreement covering their entire fleet of approximately 2,000 CFM56 and LEAP engines.
That Ryanair deal is significant. That's a single customer covering 2,000 engines.
It is, and it feeds directly into the RPO growth story. The filing states RPO increased $15.4 billion, or 9%, at the CES segment alone from year-end 2025. That's 6 months of backlog accumulation that is, quote, "as a result of commercial actions and increases to existing long-term service agreements. Management is locking in long-duration revenue streams."
What about the hedging you mentioned?
Two areas. First, supply chain. Management states explicitly, quote, "We expect the impact of supply chain constraints and inflation will continue, and we are continuing to take action to mitigate the impacts." That's not a resolved problem. That's an acknowledged ongoing headwind. Second, the Middle East. The filing states they are monitoring, quote, "the potential impact on the commercial aerospace industry, including lower utilization and increased prices, which can result in adverse effects on our airline customers." They note no material impact through June 30th, 2026, but the language is watchful, not dismissive.
And the flight deck reference. Management keeps invoking that. What's the significance?
Flight Deck is GE Aerospace's lean operating system, their internal continuous improvement framework. Management references it twice in the MD&A as the mechanism for driving cost, productivity, and improving supplier engagement. It's not just branding, it's the operational lever they're pulling to offset inflation. Whether it's sufficient is a question the filing doesn't fully answer, but management is clearly signaling it as a core mitigation tool.
One more signal worth noting. The $1 billion U.S. manufacturing investment and 5,000 new hires in 2026.
Right. Management states directly, quote, "We support efforts to revitalize domestic manufacturing and are planning to invest $1 billion in U.S. manufacturing and hire 5,000 U.S. workers in 2026, including both engineering and manufacturing roles." That's a significant capacity commitment, and it signals management's conviction that the demand ramp is durable enough to justify long-cycle capital deployment.
Let's get into the financial health picture. Red flags or confirmations? What's the verdict?
Mostly confirmations, with one structural flag worth watching. Starting with the confirmations, adjusted EPS was $2.02 in Q2, up 22% year over year. For the first half, adjusted EPS was $3.88, up 24%. Those are strong numbers. Segment profit at CES grew $0.9 billion for the first half. DPT segment profit grew $0.1 billion, or 17%, for the same period.
So the earnings quality looks solid at the segment level.
At the segment level, yes. But here's the flag. The filing shows operating income of $11.08 billion against revenue of $25.74 billion. That's a roughly 43% operating margin on the XBRL figures. That number looks anomalous relative to the 21% profit margin management discusses in the MD&A, which suggests the XBRL operating income figure may be capturing items beyond core segment operations. We won't speculate on the reconciliation, but listeners should note that management's own non-GAAP operating profit margin for Q2 was 21.7%, down 130 basis points year over year.
And the margin compression? Is that a red flag or an expected cost of growth?
Management's own explanation is that higher install engine deliveries, which carry lower margins than services, are the primary drag. That's a known dynamic in aerospace. OEM hardware is a margin-thin business. The aftermarket is where the economics shine. The causality chain here is, if install engine deliveries continue to outpace services growth, margin compression persists. If that compression deepens beyond 300 basis points on a trailing basis, the investment case shifts from a high-quality compounder to a volume growth story with deteriorating unit economics.
What about the tariff situation? That seemed like a meaningful development.
It's actually a partial positive this quarter. The filing states that in Q2 2026, the Supreme Court ruled against tariffs imposed under the International Emergency Economic Powers Act, the IEPA. As a result, GE Aerospace, quote, submitted refund requests and received a portion of previously paid IEPA tariffs. And in the CES segment commentary, management notes a $0.1 billion reversal of a majority of the tariff-related charge from Q1 2025. So tariffs went from headwind to partial tailwind this quarter, though management notes they will continue monitoring tariff policy developments.
Let's talk risks. The filing notes no new or significantly escalated risk factors versus the prior quarter, but there are some worth flagging for our listeners.
Correct. The filing doesn't introduce new risk categories, but there are 3 areas management is actively monitoring that deserve attention. First, supply chain. This is the most operationally immediate risk. Management states global material availability, quote, continues to cause disruptions and have impacted our production and delivery of equipment and services. This isn't a resolved issue. It's a managed constraint. The risk is that any deterioration in supplier performance could cap the delivery ramp that's driving revenue growth.
Second risk?
The Middle East conflict. Management is explicit that potential impacts include, quote, lower volume related to shop visits, spare parts and spare engines, and lower profitability of our long-term contracts, as well as customer credit implications. They express confidence in navigating it, given what they describe as a young and diverse fleet, but the risk is real. If airline customers in affected regions reduce utilization, GE Aerospace's aftermarket revenue, which is the high-margin engine of this business, takes a direct hit.
And third?
Tariff policy uncertainty. Despite the IEPA ruling, management states they will, quote, continue to monitor recent developments on tariff policy and evaluate any changes to the applicability of tariffs to our business as they occur. The 0 for 0 agreement with the EU, UK, Japan, and Korea provides some structural protection, but the broader tariff environment remains dynamic. For a company with a global supply chain and global customer base, that's a persistent cost variable that's difficult to fully hedge.
From a balance sheet standpoint, Mike, how does GE Aerospace look?
Frankly, the balance sheet is a source of strength, not stress. Cash and equivalents stand at $43.30 billion. Total debt is reported at $2.00 billion, with long-term debt at $20.47 billion. So on a gross basis, cash exceeds short-term debt by a massive margin.
That $43 billion cash position is extraordinary. To put that in context,
it's one of the largest cash positions in the entire aerospace and defense sector. For reference, most large-cap aerospace manufacturers carry cash positions in the $5 to $15 billion range. GE Aerospace at $43.3 billion is operating with a fortress balance sheet. Even netting against the $20.47 billion in long-term debt, the net cash position is substantial.
What about the long-term debt? Any maturity concerns?
The filing doesn't provide a detailed maturity schedule in the MD&A excerpt we're working from, so we won't speculate on near-term maturities. What we can say is that with $43.3 billion in cash against $20.47 billion in long-term debt, the company has the liquidity to service or retire that debt without external financing pressure. That's a fundamentally different posture than a leveraged aerospace supplier running thin on liquidity.
And the $1 billion manufacturing investment, does that create any cash flow pressure?
At $43.3 billion in cash, a $1 billion capital commitment is roughly 2.3% of the cash position. From a capital allocation lens, that's not a balance sheet stress event. It's a strategic deployment. The more relevant question is whether the return on that manufacturing investment materializes in the form of higher delivery volumes and improved yield, which management is explicitly targeting.
Any mention of lease obligations or working capital trends?
The MD&A excerpt doesn't provide granular working capital or lease obligation detail beyond what we've covered. What we do know is that the RPO, the backlog, grew $20.2 billion in 6 months. That's a massive forward revenue commitment, which provides visibility into future cash generation. The balance sheet story here is one of strength, not stress.
Let's break down the two segments, CES versus DPT. Who's winning?
CES is the clear volume and revenue winner this quarter. For Q2, CES revenue was up $2.1 billion, or 27% year over year. For the first half, CES revenue was up $4.3 billion, or 30%. The drivers, per management, were internal shop visit volume and work scopes, increased spare parts volume, increased install engine deliveries, and pricing. That's a clean sweep across every revenue lever.
And the profit picture at CES?
Q2 CES profit was up $0.4 billion, or 20% year over year. First half profit was up $0.9 billion, or 22%. Notice the asymmetry, revenue growing at 27 to 30%, profit growing at 20 to 22%. That gap is the margin compression story in action. Management attributes the partial offset to, quote, the impact of higher install engine deliveries, higher growth investment, and inflation. So CES is growing fast, but investing heavily, and the hardware mix is diluting margins.
What about DPT, Defense and Propulsion Technologies?
DPT is the steady, lower growth segment. Q2 revenue up $0.5 billion, or 16%. First half revenue up $1.0 billion, or 17%. Profit up 18% in Q2 and 17% for the first half. Notably, DPT's profit growth is roughly in line with revenue growth, meaning margins are holding more stable than CES.
What's driving DPT?
Management cites, quote, domestic and international government defense departments focus on modernizing and scaling their forces while maintaining flight operations, driving services demand. Defense engine deliveries increased 15% in the first half, supported by improved material supply. And the RPO at DPT grew $4.8 billion, or 19%, from year-end 2025. That's actually a faster percentage backlog growth rate than CES's 9%, which signals strong forward demand in defense.
Any notable contract wins in DPT?
Two specifically mentioned. A NAVAIR contract to supply T408 GE400 engines for the U.S. Marine Corps CH-53 Thousand King Stallion helicopter, and a contract with Turkish Aerospace Industries to continue integrating the F404 engine into Turkey's Hürjet jet trainer. These are incremental wins, not transformational, but they confirm the international defense diversification thesis.
Let's close with what to watch and where we could be wrong. Mike, what are the key metrics and dates management highlighted?
Management's forward-looking language centers on 3 commitments. First, the delivery ramp. They expect, quote, a significant ramp in our delivery of engine units and services for newer product platforms in the years ahead. That's a multi-year commitment, not a single quarter event. Second, the $1 billion U.S. manufacturing investment and 5,000 hires in 2026. That's a 2026 calendar year commitment, so execution on that should be visible in the back half. Third, supply chain improvement. Management notes that, quote, aftermarket output and engine deliveries have continued to improve quarter over quarter, which sets up Q3 as a sequential test of that trajectory.
What specific metrics should listeners be watching in the next filing?
4 things. 1. LEAP engine delivery growth, currently at 41% for the first half. Any deceleration signals supply chain friction. 2. Internal shop visit revenue growth, currently at 30% for H1. This is the high margin driver. If it slows while OEM deliveries accelerate, margin compression deepens. 3. RPO trajectory. It grew $20.2 billion in 6 months. A slowdown in RPO growth would signal demand softening before it hits the income statement. 4. The Middle East situation. Management flagged it explicitly, and any escalation that reduces airline utilization in affected regions flows directly into shop visit and spare parts demand.
Now the counter thesis. Where could we be wrong?
Here's the if wrong clause. Our thesis is mid-cycle expansion with late-cycle margin signals. What would prove that wrong? If LEAP engine deliveries continue at 40% plus growth through Q3, while internal shop visit revenue growth accelerates above 30%, that would indicate the margin compression is purely mix-driven and temporary, not structural. In that scenario, as the installed base of new LEAP engines matures and enters the aftermarket cycle, margins recover sharply and the late cycle margin signal disappears. That would make this a pure mid-cycle compounder with a long runway, and our caution on margin direction would be misplaced.
And the thesis check? Does the full weight of evidence confirm or modify what you said at the top?
The evidence largely confirms the thesis, with one modification. The mid-cycle expansion call is solid. The RPO growth, the delivery ramp, the new deal announcements, the defense backlog acceleration all point to a company with durable demand momentum. But I'd sharpen the late cycle margin signal language. This isn't a warning sign yet, it's a watch item. The 270 basis point H1 margin compression is real, but management has a credible explanation in the mix: shift toward OEM hardware. The thesis stands: strong volume, softening margin quality, and the question of whether the aftermarket catch-up materializes fast enough to reverse the compression.
Final framing thought?
At current margins, and with a $43 billion cash position against a $20 billion long-term debt load, this equity trades like a company in the early innings of a multi-year delivery supercycle. Not a peak cycle performer running out of runway. The backlog is the story. $20 billion of new RPO in 6 months is not a number you see at the top of a cycle.
Well said. That's our deep dive on GE Aerospace's Q2 2026 10Q. The filing date was July 16th, 2026, and everything we've discussed today is grounded directly in the filing's MD&A and XBRL financial data.
As always, nothing on this podcast constitutes investment advice. We're analysts, not advisors. Do your own diligence.
If you found this episode valuable, subscribe wherever you get your podcasts. Next week, we'll be back with another earnings deep dive. I'm Sarah Chen.
And I'm Mike Torres. Thanks for listening to Aviation Intelligence Weekly. Disclaimer: this podcast is for informational and educational purposes only. All analysis is based solely on publicly available SEC filing data. Nothing herein constitutes investment advice, a solicitation, or a recommendation to buy or sell any security. Past performance is not indicative of future results.